I'll start again because apparently it cut out in the beginning. Don't know why, but okay. Yeah. There's my disclaimer. We're going to talk about live market information, so please read and understand the disclaimer. I will show it again at the end. Going to talk about monetary policy today, what the general impact it has on the markets, and different issues with monetary policy. Also, how central banks can impact on the markets through various communications, such as meeting minutes or press conferences, speeches, etc., etc. I'm also going to be doing a live market analysis, so if anyone has got any questions, please feel free to ask me. And yeah, I'm going to get into this now. So yeah, just very quickly, we're going to hopefully talk about monetary policy for about 20 maybe 25 minutes and then go on to the live market analysis. So let's try and get through this as quickly as possible. Monetary policy is just one different aspect of how you govern an economy. Fiscal policy is the other side through government taxation and spending. But the central bank would drive monetary policy, and that is done through either raising or cutting interest rates, really. You raise interest rates to effectively tighten the monetary policy, and that would either be through increasing the level of interest rate charged by the central bank, or by unwinding quantitative easing. And the other option being you can lower interest rates, which is where you cut or reduce the level of interest that the central bank charges, or you increase quantitative easing. Now, quantitative easing is sort of an unconventional measure of monetary policy, and it's been used obviously in the last sort of 8-10 years, ever since the financial crisis of 2008 sort of started coming in. Interestingly, also, we're now moving into a prospect of negative interest rates increasingly, and that brings with it a whole new angle of what is going on in the markets. And it's difficult to actually know the ultimate impact of not only negative interest rates, but also to a certain extent quantitative easing, because essentially it's still one big experiment that these central banks are doing. But negative interest rates again are just adding an extra element to the uncertainty of the long-term impact of all these unconventional measures, and it could take a while to see exactly how it pans out. Now, you can see here on the chart at the bottom here, this very, very small little uptick on the Fed funds rate, and that is what's caused so much sort of stress in the financial markets recently. Is it justified? Well, I mean, in the historical context, you'd be certainly questioning whether it is justified or not. I mean, the market's having a paddy on just 25 basis points up, but I suppose it's just the path of tightening that is the problem, and it's one step down the path. So yeah, so tightening or loosening monetary policy is the two main options. They have standing pat as the third option, which is basically where the central bank does nothing, but that can also have an impact on markets as well. So why is monetary policy so important? Well, broadly speaking, pretty much every other indicator or economic indicator pretty much feeds off monetary policy. And monetary policy sort of is derived by a whole number of different aspects, but it pretty much all sort of filters into exactly what the central bank chooses to do. So, for example, I've got here in the graphic, the economy is slowing down. You get indicators such as growth falling, unemployment rising, and potentially inflation falling as well. And what can you do to combat all this? This economic slowdown is by loosening monetary policy, by cutting interest rates or engaging quantitative easing. Now, these are the big, this is sort of the big tool that the central bank has. Now, basically, the ideal case scenario that the central bank is going for is a Goldilocks scenario, pretty much is what I like to use the analogy through. And it's pretty much where the central banks want the economy not to be too hot, because that would suggest inflation flying away. but also not too cold as well, because unemployment rising or inflation falling or even moving into deflation is an issue as well in itself. So basically the central bank is going for, a lot of central banks pretty much target monetary policy that would sort of bring towards a rather sort of stable economy rather than incredibly strong or weak. So that is how they sort of tend to sort of move towards their targets. And you'll hear about the Fed targeting, for example, its 2% inflation level. For example, it doesn't want inflation to go above that, but equally it doesn't want it to go below that. So it's sort of going for the Goldilocks scenario there. Right, so how does monetary policy affect asset classes? Well, of different asset classes we've got here: foreign exchange, bond markets, and equities. In terms of foreign exchange markets, it's basically driven by hot money flows, really. You get inflows into the currency on higher exchange rates because basically you're going for the interest rate differentials. This is why the dollar has strengthened so significantly in the last year, actually, even in front of the Fed actually raising rates. The prospect of higher interest rates increases demand for the dollar, because basically they know that the dollar is then going to be moving towards becoming a higher interest bearing currency than it had previously, and certainly compared to other currencies as well, which equally other central banks are on a loosening cycle rather than Fed's tightening cycle. So that drives hot money flows into the dollar. And equally, on the flip side of that, a decrease in rates or loosening monetary policy would lead to outflows from the currency, and hence why the euro again was weakening as the ECB opted to sort of move towards quantitative easing. So that means that the increase, the demand for the higher interest-bearing currencies will mean the currency will increase in value, and that's because international sort of traders are looking to play the interest rate differentials. And in the long run, generally, I know I'm a technical analyst, but in the long run, forex trading is all about the interest rate differentials ultimately, and that sort of drives the macro trends of the forex moves, and hence why we've seen such big moves on the dollar and also the euro up until sort of last year. In terms of bond markets, you'd say that bond markets as a fixed income asset class tends to see changes in interest rates will change the relative attraction of domestic bonds. So basically, you need to keep in mind that bonds are fixed income, and an increase in interest rates will mean that the relative attraction of holding cash over bonds, and also to a certain extent other assets as well, but mainly cash over bonds, will change, and therefore the demand for bonds will fall because that relative attraction has changed. So basically, if you're getting sort of more interest holding cash, then there's going to be a demand or a shift in demand for cash over bonds. Therefore, bonds will be sold off. And pretty much simple demand supply economics suggests that the bond prices will fall and yields therefore will rise. So you've got to sort of remember the inverse relationship you've got between price and yields on bonds. Acts like a seesaw, effectively. In terms of equities, it's an interesting one actually, because changing interest rates sort of changes certainly changes the corporate borrowing rates at both the bank and also the way that corporate bonds are priced. And companies, for example, in recent years have been taking full advantage of sort of these record low borrowing costs, and many have used that cheap debt to be able to fund equity buyback programs. And that's basically because it's cheaper to repay the debt than to pay out dividends. So in terms of if the company can buy back its own stock, it reduces the amount it has to pay out in dividends. And if it can fund that through corporate debt, which tends to be cheaper equity dividends and equities. It can certainly help also to boost the share price of the company as well. So you could almost get a double whammy from that. And in terms of the companies themselves, changing the interest rates or increasing the interest rates has got an impact on the companies. I mean, if they are say, for example, consumer-facing corporate companies, sort of like with housing, retail companies, such like that, you sort of the increase in interest rates sort of acts as a to sort of reduce the spending power of the consumer, and that can have an impact negatively on the corporates as well. So generally speaking, you'd say that equities are going to be impacted negatively by an increase in interest rates. Now, so I mean, the little yellow box here at the bottom, so it goes on about an increase in interest rates. So as a summary, you'd say an increase in interest rates should strengthen domestic currency, weaken domestic bond prices, and weaken domestic equities. But you'd say that there's a caveat to that, because obviously, in terms of the equities, certainly the sort of drive towards normalization, because we're at such extreme times in terms of monetary policy still, you've got this suggestion that normalization of monetary policy, whereby the Fed would increase interest rates, should or could actually have a positive impact on equities, because it sort of generally would be coming because of the Fed is far more confident in the outlook for the US economy. So I suppose it depends on what sort of base you're coming from in terms of monetary policy, really. I suppose if you're coming from a very low base, then normalizing monetary policy would be seen as a positive for the economy, and therefore equities could benefit off the back of that. But if you're going from a factor that you're increasing interest rates because inflation is just running out of control, then that would be seen to be a negative. So I suppose it depends on exactly the base case where you are in terms of the economy as a whole, and why you're increasing the interest rates. So the real market impact of monetary policy. Well, as I said earlier, monetary policy divergence is absolutely key. It's everything, because it derives the volatility. Just in the past few years on Eurodollar, there's been a classic example, really case in point of this, whereby you had the Eurodollar falling from 140 to 104.50, and that fell in the space of about 8 or so months, 8-9 months, and that was basically driven by the first. I mean, that as you can see here, that box is pointing towards the high in pretty much the high in Eurodollar, which was on the day of the ECB meeting in May 2014, when Draghi first started talking about the prospect of using quantitative easing, and ever since then, or in the subsequent 9 months anyway, the euro fell drastically. And that was pretty much through 2014, and then you started to see it sort of bottoming out and starting to move sideways in 2015. Now, interestingly, because 2015 has come with sort of the pricing in of the Fed tightening. 2016 is going to be a year of, I think, massive volatility, and it already has been, and I think that's going to continue throughout this year, because what we have got is the massive divergence in central banks in terms of their monetary policy. You've got the ECB and the Bank of Japan both easing rates, and not only that, they're going into an era of negative interest rates as well, so ramping it up even further. The Fed is in a tightening cycle. Exactly how that pans out this year could be a bit choppy, because the market is sort of tends to go a bit too far ahead of itself. It seems as though in the last sort of few weeks we've got some US data that would suggest that the chances are we're going to be having rate hikes back on the table. Very, very likely to be 1, if not 2, this year now. Just the way that the data has sort of come through in the last few weeks maybe would suggest possibly June and December, but that's open for debate, clearly. And And not only that, you've got another central bank, which is the Bank of England, which is massively flip-flopping in terms of, well, the perception is that it's massively flip-flopping on tightening. Bank of England should be moving towards tightening theoretically. There's not a great deal that's stopping it from doing it, but maybe it's well, the expectations of the Bank of England is sort of pushed out into 2017, possibly even mid 2017 now. So exactly when it goes, I mean, it was expected. Certainly last year, the market was sort of factoring in a possible 2016 monetary policies rate hike. So the 2016 is a big year for markets because I think we're going to have continued massive volatility in these markets on monetary policy as well. Okay, so how else can central banks impact on markets? Well, four main ways really: official statements, press conferences, meeting minutes, and individual member speeches. The official statements are interesting. Certainly, the market. I mean, last year, the market, or last couple of years actually, the market has been absolutely sort of spellbound by just single words on the FOMC statement. Do you remember when considerable time was then replaced by patience, and that was at the beginning of 2015, I think it was, and then patience was came in the next couple of statements, and then patience was removed, and the market immediately started to look for the rate lift off. So these statements do have a big impact on the market. The Fed is also big on the dot plots, and you can see here the graphic here. It doesn't come out brilliantly well, but I hope you can see it. You got the dot plots for the December meeting, and as you can see, the 2016 average projections gives you about 1.5% on interest rates in 2016 on the average. Now, clearly, that was in December, and markets had a massive paddy on the back of the rate hike, and possibly even the dot plots as well. And since then, we've had huge volatility, and everyone sort of factoring in the fact that the Fed wasn't going to be able to do 4 rate hikes in 2016. Now, the dot plots are presumably going to, well, they should change. Well, they certainly will change, because obviously this next meeting coming up in March, in a couple of weeks' time, will contain the dot plots. And if they haven't hiked again in March, which they're not going to, surely they're not going to, we're going to have different dot plots, I think. Otherwise, it's going to look a bit odd, because the market pretty much knows that they're not going to be hiking every single meeting, and every other meeting is a press conference, and this is a press conference meeting. So if they don't hike this time coming up, they're only at the max going to do 3, more than likely, possibly 2, most likely 1, but it just is, again, it's open for debate. So yeah, and that's those dot plots have a big impact on the market. Also, you got forward guidance, which is just basically whereby central bankers such as Mark Carney love to use forward guidance to talk about when they're sort of looking towards sort of moving towards rate hikes. It hasn't proved exceptionally successful for Mark Carney, has to be said, because he's sort of had to backtrack a couple of times, and you could argue that's justified in the fact that the financial markets have been so volatile and moving around so much that obviously the ballpark does change, or the goalposts do change anyway. So it's not an easy way of guiding, but there we go. Mark Carney does try to do it. Anyway, press conferences, another one. Big volatility events press conferences, aren't they? I mean, the ECB and the FOMC are the two classics. ECB press conference has been a big driver of volatility in the markets in recent press conferences over the last sort of year or couple of years, really, and also the FOMC press conferences as well. So, and I've got a little graphic at the end that I can quickly talk to you. But generally speaking, press conferences are drivers of volatility. Meeting minutes can also be very important, especially on policy decisions that have no change, and the market needs to sort of get a bit more clarification as to who's moved and the different sort of intricacies of the monetary policy, and again, especially when there's no press conference, as the Fed has a press conference every other meeting. The meeting minutes can put vital bit of detail into that into the outlook. Member speeches as well, specifically thinking about the ECB and the Fed here. Really, you sort of target in individual speeches, and they can definitely be market movers, because obviously if they change their outlook, moving from, say, for example, a dove to a hawk, or even a hawk to a dove, it can be quite big in terms of volatility events. So that sort of takes me to hawks and doves on the committees. Hawks are optimistic about the economy generally, and they sort of fear the potential for an overheating economy, and the natural persuasion is for them to be sort of tending towards pushing for higher interest rates. Doves, on the other hand, are the opposite. They're sort of more more cautious, or less optimistic, I suppose, and they'd be sort of moving towards loosening interest rates or loosening monetary policy, and they sort of tend to feel that things like systemic shocks are still going to be playing out, and they're worried about raising interest rates that's going to possibly choke off the recovery, and could even sort of pull an economy back into recession. So they sort of favour far more accommodative monetary policy. You've also got a third category, which is called the centrists, I suppose, and they're basically fence sitters, could swing either way. And there was a sort of a famous quote from Bank of England's Mehmet Shafiq, who called herself an owl, who basically said she would look at the data and then be wise. So these people sort of sit on the fence and can move either way. And you can see here you've got the Fed Dove Hawk scale, which was a little arguably a little bit old now. Well, it is old. It's mid-September, so I haven't seen an up-to-date one. Maybe I haven't looked at the right places. But this is the Fed Dove Hawk scale from Reuters, and you can see here that how these sort of members tend to sort of veer on the committee. Yeah, that can give you a bit of a guide as to what they come out with on their speeches. Now, as I said, the press conference, and it can have an impact on markets, and this is basically we've got the ECB press conference, or the ECB monetary policy, coming up next week, and I thought I'd sort of just look at the what we saw in the December meeting, because obviously we had a big disappointment of monetary policy in the December meeting. During the press conference, we had some significant moves, and this was the last time the ECB did any real move on monetary policy, and we're expecting a move again this time out. Now, looking at the German 2-year Schatz, it would suggest that about 20 basis points to be cut off the deposit rate. Now, this was exactly the situation, pretty much very similar to what we saw back in December. The market was sort of pricing in a 20 basis point cut to the deposit rate, didn't get it, and there was a massive jump in the euro. It actually called the bottom on the euro in the big December low, and the euro then subsequently rallied sort of 700-800 ticks off the back of that, plus other factors, but still it was the start of a rally for the euro anyway. But you can see here that this was the monetary policy decision, 12:45 UK time. And the expectation was for a bigger than expected. Sorry, expectation was for a bigger cut to the deposit rate. It didn't get it, so the euro rallied. It then settled down, and then it had another move, and that second move came on or during the press conference for the ECB when Mario Draghi again sort of because the expectation was that they were going to increase monthly purchases to the ECB quantitative easing program. It didn't get it. They just sort of extended the program by 6 months. They didn't increase the monthly amounts, and then the market again took that as a big disappointment. So we then saw a rally from sort of 106.50 to 108.90 in the space of 15-20 minutes. So massive volatility you can see. And the point I'm trying to make is you can get on the back of these moves. As soon as you start to you get that announcement, you can still be on the back of this move and trade with it. For example, here the announcement of the original monetary policy decision of a 10 basis point cut at 12:45. You then saw for the next 25 minutes, half an hour, you then had further moves. So it's not like it's an instantaneous move that you miss out on. You can still get on the back of this when you get these press conferences and these monetary policy decisions. So these are all big moves that you can sort of still play out. It says here trading was obviously very quiet in front of the moves, and also volatility increased with increased volume as well in the wake of the policy decision. So you can see that traders were waiting for the decision and then went with that move. And yeah, you can. They do take time to plan out, so you can get on the back of them. Very interesting. Right. Okay. Well, that. Is that theory part. So let's just look at markets. Now, I'm going to start off with the DAX because what we have seen, actually, no, I'm going to start off with a very quickly run through what's actually going on here. We've got a lot of increased positivity in the markets. You've got the 2-year German yield, sorry, 2-year Treasury yield, which is increasing. That's certainly in light of the positive moves that we've seen in the US data recently, and the US 10-year, and that I find that 10-year is a better indicator or a better sort of signal for the markets that the market is more positive than just the 2-year alone. Now, the other key moves we're seeing, metals prices breaking out. We're seeing a breakout on the copper. That is a head and shoulders reversal if you're a technical analyst, above 47.41 in dollars per ton. You've seen oil prices trying to break out. Certainly Brent crude has broken out. 36.25 is the old resistance, big pivot line resistance. That has broken out to the upside. That's a positive for the market. Brent crude has done it. WTI hasn't yet. 34.80 is the resistance on WTI. And it almost made the move yesterday, but didn't quite. So if it does make the move above 34.80, that is a big reversal pattern again. That is the 21-month downtrend. Let me just go back 2 years, and that is the start of the massive sell-off in oil. That is a mega downtrend that we are on the brink of breaking through on oil. So is this the possible sort of start of a recovery in oil? It certainly looks like for now we've bottomed. 2 big lows there, $26 on WTI. The equivalent is 27 on Brent crude. But yeah, oil price breaking out. So this is all market. These are all sort of moves that are market positive. So that's interesting. So what's happened subsequently? We've seen the markets basing out. We've seen the DAX starting to rally. Now the DAX uses the Fibonacci levels. Anyone who follows their technical analysis will know that Fibonacci is a number retracement that technical analysts use, and 76.4. Well, basically, the DAX throughout the last, good Lord, year has used these fib levels as an enormous sort of turning point. Time and time again, the big turning points have come with these fib levels. Incredible. And what did we see on Monday? we saw the low coming in pretty much on that fib level, 93.08, and that was 93.32. We're seeing a rally now back towards what is I think is going to be the next key fib level, 99 or 98, 97, 99.05 was that rally high in late Jan before further downside. If we break above that move on in late January on the DAX, then well, that is a really strong move, and that is the first real technical signal that we would see for the bulls returning. You've got a strong momentum, certainly the RSI's strongest level since December. So again, that is really indicative of a nice turnaround. What is driving that? Well, the euro is weaker. DAX and the euro throughout the course of recent trading over the last year or so, DAX and the euro have been sort of negatively configured. I mean, that correlation, negatively correlated. That correlation isn't as strong as it once was, but certainly in the last few weeks, euro's been falling, DAX has been rising. And the euro continues to fall. It looks like it's sort of moving towards this old floor, 108 figure. Now, if I zoom out, you can see 108 figure had been a consistent sort of pivot line. So 108 figure is a big level near term, but look at this RSI back at lows. Back at a level not seen since December. So I think that is going to put big pressure on 108 figure. The big support medium term is 107.10. If you break 107.10, I think you're sort of retracing towards the lows again. But these momentum indicators are not positive in any way, so that's not great. Cable is interesting. It has been a big sell-off. It's sort of buzzing around at the moment. I mean, it's sort of trading, looking to try to a certain extent 104.80. That is, sorry, 140.80. Trying to rally, but I think the fact that we've broken such key levels on cable, I think any rallies are a chance to sell. I think you've got this slight improvement in the stochastics, which I wanted to point out, and I'm not convinced that that's going to be a buy signal on the stochastics. I think that there is the likelihood that it's just unwinding a little bit of that oversold momentum. Really, I don't think that's going to be. I'm not taking that as a buy signal. I think that rallies are a chance to sell on cable. Every time it gets above, or every time it has got to above 140 in the last 4 or 5 sessions, it's failed. So I think that is interesting on cable. Now the Aussie is interesting because we've had are we having a, oh dear, hold on, so reset that. Now, interesting, let me just get rid of that. Now the Aussie is interesting because we've got this uptrend, decent uptrend, but also got a breakout 72.60. 72.60. If that breaks above that, then we're going to go to 73.80, I think, which are these key highs from October, December. Now, the pressure is certainly suggesting that we're getting this move, but look at this RSI again, up towards 60. It needs to make a decisive move above 60, I think, to really suggest the bulls are in control. Yeah, I think that. Yeah, am I trusting it? I'm not sure yet, because seeing the MACD lines just rolling over a touch. Stochastics, again, they're okay. They're pretty positive actually, the stochastics, but the MACD lines and the RSI needs both of those need to pick up. Just had a question about oil inventories going up again yesterday from Pan. Will this mean short-term fall in oil price? Now, okay, so let's see. Oil. Oh, that's annoying. So just CLC1. Right, technicals on oil. That is not the downtrend. That's not the big downtrend. That's a shorter downtrend. Technicals on oil. With, as I said on that on my opening to talk. We've got the improving outlook. Now we've got the inventories this afternoon. 3.5 million barrels is the expectation on the EIA report, and you'd think that increasing inventories is a negative for oil, and it tends to be that case. But there's an awful lot that goes on in the oil inventories report that you need to be mindful of. Now, let me just show you. On Reuters, for example, you've got all these different aspects. Now, the market focuses on, to a certain extent, the headline, which is the 3.5 million expected barrels increase, but also looks at these two as well, the weekly distillates and also the gasoline stocks as well. Now, the last couple of weeks, they have been declining, and that was seen as a positive because it sort of paints a wider picture, really. So don't just look necessarily at the headline, look at these other factors as well, and these two are expected to show a decline, which would be a positive actually for oil price. So there is more to it than just the sort of headline inventories, so just bear that in mind. But certainly at the moment the oil price is rallying. The thing I like about the oil price in terms of the technicals is this RSI moving well above 50, highest since November. MACD lines positive. Look at those stochastics, really positive on the stochastics. So it really is turning around, I think. And I think that is an indication that we're going to see pressure or further pressure on that 34.80. So if I just do that, 34.80, which is the big level. 34.80 is the big level. And it's sort of obviously coming to a bit of a head, isn't it? You've got this uptrend and you've got the overhead resistance 34.80. So it's coming to a bit of a sort of an apex, which means either break out or break down. So yeah, it'll be very interesting to see which way it goes. But the oil inventories report this afternoon at 3:30 certainly has a driving element of volatility for oil. Let's look at gold, because gold has been another interesting one. Now, what we have on gold is what I can see is this uptrend, which is good, positive, higher lows all the way through the last 3 weeks. But look at these momentum indicators. That RSI has now broken that uptrend. It is also falling away, I think. Look at those MACD lines having sort of bear crossed and falling away. Stochastics as well. That's the other one. Stochastics falling away. So I'm just not 100% convinced that this gold price is going to go too much further. Actually, we might get a retest of 1260, but I think I get the impression that this market is in the process of topping out, or at least it's going to sort of start to just drift back again, maybe towards that old big breakout at 190. 191, which is that big October 2015 high. Could see a drift back towards that. I'm not 100% convinced that the bulls have got this one anymore, and leaves me very, very reticent to sort of back this as a long play without any real sort of further gains. But I do like the oil price, the gold price as a near-term uptrend. That's okay, but I'm just concerned that these momentum indicators are sort of playing out a bit of a sort of a waning upside move, which we need to be aware of. And the other reason is look at silver. Silver has already broken down, and you've got these sharp deterioration in the indicators. So that silver chart doesn't leave me with massive amount of positivity in terms of how it's all playing out. Now, let me just. I was going to show you the gold silver ratio if I can find it. There it is. Here we go. There's the gold silver ratio. Anything towards 45 looks extreme long term, but equally anything above 80 is very extreme. So if we sort of pan out and do a 20-year view, you can see that anything above 80 is extreme on that gold silver ratio, which would suggest we're sort of at extreme levels on gold. I think, and we're getting very close to what is likely to be a gold correction. The only alternative way of looking at it would be a massive silver rally, and I don't necessarily think, looking at that silver chart that I've just shown you here, I don't think we're going to get a silver rally. Now, we are back at support 1465, which is holding to a certain extent, but I just don't think these momentum indicators would suggest we're going to get an almighty silver rally, which would sort of unwind that gold move. Now, that, I think, for me, gives me a few reasons to be a little bit cautious on gold at the moment. Anyway, right, so let's have a bit of a summary, really, on what we talked about earlier. We had talked about monetary policy today, didn't we? And the impact that it has on markets, and why it has an impact on markets. And basically, it's because it's sort of the interest rate differentials are a big impact, certainly on foreign exchange, on foreign exchange and different currencies, because it impacts on hot money flows. So when a central bank will move interest rates, that increases the demand for the currency, the local currency. Therefore, the interest rate differentials and the expectations of interest rates will change, and therefore hot money will flow into the currency. Therefore, you'll see an increase in the price of that domestic currency, and the exchange rate will improve. Bond markets, you're looking at sort of the sort of fixed income nature of the beast will mean that when you increase interest rates, it sort of reduces the relative attraction of bonds. So bond prices will go lower, yields would go higher. In terms of equities, you're looking at a whole range of different things actually that could have an impact on equities. Generally speaking, though, that it would weaken domestic equities. So yeah, and this all comes about because of our changes to monetary policy, whether you raise and lower rates, and that is sort of pretty much my presentation. So I wish you good luck in all your dealings today and in the coming days, and I will leave you today with the disclaimer, which you need to have read and understood. So thank you very much, and I will speak to you next time. Thank you.